Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. With the cash trade just less than an hour away, here's what you need to know. Higher for longer. The Fed holds rates steady for a sixth time in a row. Fed Chair Jerome Powell keeps rate cuts on the table, but the timing is less certain.
I do think it's clear that that policy is restrictive. I think it's unlikely that the next policy rate move will be a hike.
The yen weakens after a surge of over 3% in New York trading fuels speculation of intervention. Plus, another big day for earnings in Europe, with Novo Nordisk quadrupling the number of patients starting on its weight loss drug Wegovy in the United States. We will bring you more European results and a live conversation with the CEO of Maersk.
In the meantime, a quick check on these markets here. When you look at the futures trade, you are seeing outperformance in the FTSE 100, higher by about 0.5%. By comparison, the Euro Stoxx 50 futures doing a whole lot of nothing, unchanged at the moment. We'll see if that changes closer to the open. The two-year yield in the meantime, 4.94, a very careful retreat after Chair Powell's commentary. We're going to dive into the numbers there. And Brent crude getting closer to 80 than 90. Interesting dynamic there. Markets today starts right now.
In recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. It is likely that gaining such greater confidence will take longer than previously expected. I think it's unlikely that the next policy rate move will be a hike. I do think it's clear that that policy is restrictive, and we believe over time it will be sufficiently restrictive. I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope. See if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. We just don't go down that road. If you go down that road, where do you stop?
Fed Chair Jay Powell telling the market nothing it already hadn't figured out for itself. A big nothing burger, as one of our commentators said here at Bloomberg. In some ways, the market reacted as you would have expected. Initially, yeah, we're not going to get a hike, as a result of which stocks rallied. Then the reality of higher for longer kicked back in again. Markets went back down again. A nice little round trip. European equities this morning are called higher just. We'll see exactly what that open looks like, as Kriti says, as we get closer to the start of play here in Europe. Hong Kong is looking strong this morning, which I think is an interesting divergence. And we've had that yen story, which we need to factor in. But given all of that, I don't think the world has moved forward much on that Fed story. So we turn back to the story that we're focusing on right now. And that is the earnings story this morning. We've already had Maersk. It looks like it's beaten. Shell's looking good. Standard Chartered's looking good. Novo Nordisk has knocked it out of the park once again.
Yeah, strong session then, it seems, in terms of the earnings stories out of Europe. Going to Shell first. Shell announcing a share buyback program of $3.5 billion. And there's a T-Live blog, a Top Live blog running on the Bloomberg terminal, so you can find commentary and thoughts there. The question going into these numbers was whether they would maintain the pace of buybacks that they set in the first quarter. Yeah. And the answer is yes, because that was $3.5 billion, and this is $3.5 billion. So interesting on that particular front, but a lot of the numbers under the hood as well. The adjusted profit number looking much stronger than anticipated.
Yeah, we're at $7.73 billion for the first quarter. The estimate was $6.3 billion, so a pretty significant beat there as well. Shell also had been outperforming because of their natural gas business as well, and that was really kind of a question of whether that was a one-quarter thing or if that was going to continue into the years ahead. As we get more of those headlines come out, we'll, of course, bring you updated. But sticking with that commodities theme, the Maersk story is really interesting as well, because 3 months ago when we had Vincent Clerc on this very program, they suspended buybacks, they suspended their guidance. They were really concerned about the kind of hit that the Red Sea was taking on their numbers. Now they're saying actually guiding towards the top end of their market guidance, really saying the demand is actually outweighing some of the issues you see in the Red Sea.
Demand is strong, the economy is strong, the global economy is looking like it's in fairly good shape right now. Europe is re-accelerating. That's great news as well. There's a capacity story we should talk to him about, but it does seem as if the Red Sea story is going to be with us for a while, and the Houthis are increasing their attacks. In fact, they're pushing out into the Indian Ocean, making it kind of less likely that we do see some sort of conclusion to that. But then I would flag as well what's happening between Saudi Arabia, the United States and Israel. You get a conclusion there. What happens? How does that impact that Houthi story as well? Yes,
and I know we had inventory data out of the US, but it was also that geopolitics that weighed little on oil prices. And back to the Shell story, also something, that geopolitical overlay that we need to keep in mind. On Maersk then, and on how the geopolitics plays out there, they are saying this morning, early comments from the CEO on just that subject, conditions in the Red Sea policy remain entrenched, that they're stay for most of the year. That's the assumption that they are making at Maersk. Demand growth staying positive in coming quarters, though, to the more positive side of things. Because on the one hand, demand's not been too bad, and they've managed to benefit from higher freight rates. But on the negative, the longer journeys, that costs.
It does, and I think you were mentioning the Shell buybacks earlier as well. The other kind of stories, the buybacks we're seeing again in the banking space. ING was another one that reported this morning as well. They're coming out with a €2.5 billion buyback as well. The bank's buyback story is interesting. We had the CEO on earlier in programming, specifically talking about the read-through from the Fed into the ECB and therefore into their net interest margin. I think we're going to bring you some of that sound later, but I thought it was really interesting that you're now having CEOs actively talk about and evaluate what kind of damage it's going to be doing to those peak margins.
I think the returns to shareholders is important because in some ways the market's already front-run this. This is confirmation of what the market has already priced in. You guys have got excess capital, you're going to be returning it to us. Is this enough to keep the momentum in that banking story? That, I think, is the question that I think we're going to have to look at in terms of the size and scale of how much actually is going to be coming back.
So we're going to be discussing all of these earnings. The CEO of Maersk is going to join us shortly, as well as the CFO of Novo Nordisk. That's a little bit later on this morning at 9 a.m. UK time. So those are the earnings stories. That's the micro news flow that we're dealing with this morning. There's plenty of it. We'll keep an eye on all of these share prices in just under an hour's time and see how they trade. The other thing that European markets are reacting to for the first time, or will do, is the Fed story. And as you suggested, Guy, not a great deal of new information, but they didn't. But Jerome Powell was not suggesting that they'd be back to hiking anytime soon. I don't think anyone suggested his hawkishness might lean quite that far. But there was a fear going into these meetings that maybe he'd be more hawkish than he was, at least in some quarters.
There was, and I think there was a big onus on communication here. He had to really talk down the market, which he did effectively. And I would also argue that the market was kind of selling off, the stock market at least, going into the meeting. So the actual reaction was quite limited. To me, the highlight of this was the QT program, because even though you were kind of maintaining this rhetoric on the front end of the curve that's keeping front-end yields high, you were still tapering off your quantitative tightening program. We're going down from, I think, starting in June, something like $60 billion a month down to $25 billion a month. I loved what Alberto Gallo over at Andromeda Capital tweeted. He said it's the equivalent of pulling the handbrake while also pushing forward the accelerator on the long end of the curve. And he said that creates a really interesting kind of dynamic in the bond market. And my question to both of you, I imagine, is this some sort of, I don't want to call it yield curve control or job owning or anything like that, but is this the appropriate kind of guidance that the market is looking for from the Federal Reserve of where they think yields should be?
It certainly was where a lot of the focus of the statement was. I was looking at the side-by-sides, and there wasn't really much change, apart from this large chunk of new text around QT and around the new numbers there.
But again, there's been this expectation they have to do this. If you look at the overnight lending markets, it's starting to get tighter. There is less liquidity in the system. They have to maybe make this change. What I thought is interesting here, though, is that there's no end date. And he was asked about this. There is no end date. This is lower for longer. We couldn't have maintained it at the pace of 60, but we're going to be bringing it down to 25. That's going to be the cap, and then that's going to carry on for a much longer period of time. So ultimately, what effect does that longer period have as well in terms of the liquidity story?
This starts in June, right? May 29th is when the Treasury buyback operations start. Now, it's not by the same margin as well, because we got that announcement 30 minutes before the Federal Reserve yesterday. They're looking at about $2 billion in terms of those support buybacks going through July of 2024. So it's only like a 2-month thing. But the timing is interesting because that kind of switch happens at the same time.
And if I have no answer to your question, Kriti, we certainly have plenty of guests coming up on the programme who can weigh in on the fixed income side of things and give us some further thoughts on that. So that will certainly be something that we will continue to pick up on and continue to explore when it comes to QT. I mean, the Fed seems to be going to some lengths to separate what they're doing on the balance sheet from what they're doing on monetary policy. Alberto doesn't buy that argument, it seems, and many in the market won't either. But that's certainly what they are suggesting. Let's talk about what's going on in the yen, because as we mentioned in the headlines, we saw the yen surge in the New York session, up by 3%, almost to 153. Was this more,
Kind of felt like it, didn't it?
Was it more intervention? But was it intervention the first time? I mean, there were plenty of voices on the terminal this morning saying, yes, these look like intervention again. And it was really interesting timing, because they waited perhaps for the end of the press, for the press conference, and for the part where they saw some dollar weakness, as Powell was saying it was unlikely interest rates were going to rise again, that they were going to hike again. And that maybe seemed like a good time to get involved. And
it's like liquidity, end of the session. They can get involved. They can have a much bigger effect. Japan's about to go on holiday. So you've got to factor that into your thinking. Good luck if you want to take a holiday and you're
Everyone's
Japanese.
going on holiday.
Yeah, even you.
I know.
So
I can't really complain.
Kriti bringing that one up once again, our Spanish correspondent.
Had to.
But you've got Japan on holiday tomorrow. I don't think many FX traders in Japan will be taking that holiday. And London's closed on Monday, which is a big centre for FX trading as well. So there's light liquidity conditions over quite an extended period of time. Do they want to front-run that? Do they want to kind of put a statement down once again into that? Do they have to come through and deliver maybe more of that over the weekend as well? I don't think many people in the FX world are going to be taking this holiday. Bad luck.
Yeah, bad luck. I don't know if you saw Jim O'Neill's comments. Clearly, he's somebody of interest to talk to you about what's going on in markets with all his years of experience. But he was saying the Treasury also won't want to see extreme volatility in the... Yes, exactly. So the US Treasury won't want to see extreme volatility in the yen, and going so far as to suggest that maybe the Treasury would also in some way do what the BOJ would like them to do and intervene to some degree. But anyway, we'll wait to see what confirmation we get, at least from the Japanese, at the end of this month.
Yeah, we should also point out that historically we know that the Japanese have intervened in their currency as of many times. But in the 90s, when you start to see even more extreme conditions, you have had coordinated currency moves with the U.S. Treasury, for example, with the BOJ, with the ECB. We haven't gotten to that point just yet.
Our currency, your problem.
Well, our currency, your problem. But yes, it's fascinating. Also, what is the longevity of this, right? If you start to see the volume pick up as well, can they keep doing this? Is the light liquidity conditions working right now? Will it work in, say, 2-3 weeks, 3 weeks' time? So we're going to be watching that very, very closely. Let's bring up some of the other things that are on our docket. At about 1:30 p.m. UK time, more U.S. data to keep an eye on. Initial jobless claims coming out, plus that trade balance data as well. Remember, the job market is still very, very much in focus. And that initial jobless claims, perhaps a leading indicator on what we could see in the broader payrolls data, which is also coming tomorrow. 3 p.m. UK time, U.S. factory orders, durable goods data, housing manufacturing sector. Looking in the States, we'll have that for you as well, live on Bloomberg TV. And later, of course, it's more U.S. earnings. The Apple story, fascinating. Booking.com, Coinbase, Live Nation, cough, cough, Taylor Swift. Just saying.
Always a reference. She makes it into this show an incredible number of times. I don't know how she does that.
I know, we're trying to balance it out with Enrique.
Apple earnings, and we are expecting for the 5th time to see a drop in sales at this absolute tech giant. It would be the 5th in 6 quarters, actually, and they're losing share to rivals. We've talked about there are difficulties in China many times. We're looking for an update on AI strategy. Clearly, that's something others have been talking about a lot, and apparently also the Vision Pro headset. I haven't got one, so
haven't you?
Can't comment. No.
No, I haven't got one either. I've got an Android.
There was a lot of judgment coming from you.
There's quite a lot of bad news in Apple, though, isn't there?
Yeah.
So you do kind of wonder where we are in terms of the expectation management story, precisely, and, well, just expectation story. I'm not sure there's much management going on. And whether or not that could lead to the potential for a surprise here.
Is Apple still a macro story? Does the broader S&P 500 still care about the Apple story as a kind of proxy for the consumer, proxy for global trade, et cetera? Or do you start to see that divergence between Apple stock and the broader market?
Bit of a geopolitical story as well, isn't it? Also. Right, coming up on the programme then, Standard Chartered reports first quarter results beating estimates, boosted by trading and its wealth business, whilst ING announces a fresh share buyback. We'll dig into all of these European bank earnings stories a little bit later on in the programme for you. Plus, the US and Saudi Arabia are said to be nearing an historic defence pact that would potentially reshape the Middle East. We'll get the latest from that Bloomberg exclusive story and look at the impact on oil. Up next, Maersk reaffirms its global container trade forecast for the full year. We'll speak to the CEO, Vincent Clerc. He's going to join us shortly. If you have any questions, you want to weigh in on these conversations, please do get in touch. IB plus TV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
Good morning. Welcome back. Tuesday, the 2nd of May, 17 minutes past the hour. We've got 42 minutes and there's still the start of equity trading here in Europe. We've got a lot of corporate news that we need to fold in to today's session, plus also the Fed, of course. That is what we're thinking about too. Let's start with one of the bigger corporates that we're seeing reporting numbers this morning. That is A.P. Møller-Maersk. The numbers look good. The key line that seems to stand out at the moment is that this shipping giant is seeing its full year global container trade outlook at the upper end of its guidance. Let's talk about why it has the confidence to make such a statement. We're joined now by Vincent Clerc. He is the CEO of this company. Vincent, good morning. Thanks for the time. Thanks for joining us here on the show. What gives you the confidence to put a line like that out, that you see fully a container trade at the upper end of guidance?
Yeah, I think what we have seen actually consistently since already the second half year of 2023 was a real resilient market, a recovery into the US and a very resilient market in Europe, actually ahead of some of the macroeconomics that you're reading about. And this resilience has continued in the first quarter here and seems set to continue also well into the second and possibly the third quarter. On top of that, we've seen actually markets into from the Far East into emerging markets actually take a positive turn with respect to container demand. And we're seeing today very strong demand into Africa, into the Middle East, and into Latin America, for instance, that are driving a very positive sentiment for what this is going to mean for container demand here in 2024.
There's a lot of excess capacity coming into the market as well, though. I say excess capacity. It doesn't feel like it's excess now, but maybe it will do in the future. In terms of kind of the supply-demand balance right now, it feels like it is in balance, and you're able to talk about a positive picture. But to what extent is that being driven by the story out of the Red Sea, the story out of the two canals, which are so critical, the Panama and the Red Sea Canal right now? How much of that is masking what is going on underneath in the market and giving a false impression maybe of the fact that this market is in balance?
No, I think you're absolutely right. There is a shortage of capacity today because of this combination of strong demand, but also because of the demand for extra capacity that there is to cope with the Red Sea disruption. Just a few months ago, we were looking at a much more dire picture with a lot of new tonnage coming in and maybe a more subdued demand, which would have created a very different environment for us to operate in. This gives us this strong demand and these disruptions gives us a temporary reprieve, which is very positive for 2024. But we continue to be concerned if over the longer run by potential downside risks on the macro, on container demand as interest rates stay higher for longer, and also on continuing to see a lot of these new vessels coming online, and that will eventually, on a fundamental basis, mean overcapacity coming in and price pressure returning to the market.
Vincent, as Kriti in London, can you expand on the security situation in the Red Sea? When are you forecasting that those are safe waters to go through again?
Yeah, I think what has become clear compared to just a few months ago is that the situation is becoming more entrenched. The conflict is becoming more entrenched. We have had to rejig all our network to be much more permanently set to sail south of the Cape. Our view right now is that at minimum we will be well into the second part of the year before we can even consider restarting the network, and the possibility that by the end of the year we will still be sailing south of the Cape of Good Hope has certainly increased significantly since 3 months ago.
What would you need for those security conditions to look better, especially as I think Guy mentioned earlier in the program, the Houthis are actually expanding their attacks, not actually bringing them to a close. What does a safer security situation look like in the absence of just back to completely normal?
Yeah, given how dynamic the situation is, it's actually very difficult to be able to paint a picture of what are the different points or things that we would need to see. As you rightfully say, the situation in the last few months has seen more escalation than de-escalation, and that's what leads us to actually believe that this situation is going to be with us for longer rather than shorter. What the solution looks like, I mean, it's hard to see a good solution that doesn't come through a resolution of the conflict between Hamas and Israel, which is what triggered actually the situation in the Red Sea. And it's hard to see actually from the experience that we have had in the past few years that without a solution in that conflict that we would get to a military solution in the Red Sea that would guarantee safe passage for the trade. I think it's very difficult to see that.
Vincent, good morning. Can I ask you about contract negotiations? Clearly, during the pandemic, the industry benefited from much higher shipping rates and then managed to lock some of those in after the pandemic through longer-term contract negotiations. So tell us about the trajectory of the shipping rates you'll be able to secure because of what you're able to do on those longer-term negotiations.
Yeah, it is clear that given the shortages that we have seen since the beginning of December and that are set to continue for at least another quarter, maybe two, we are able to secure in our contract higher prices than we would without that situation and that tightness on supply and demand. And that is contributing also to us lifting the bottom of our guidance for this year because we have much more confidence in both the operational situation, the volumes that are in the market for us to transport, and the prices that we can achieve in this set of circumstances.
Vincent, in terms of the competition in the market, I understand from colleagues that MSC has replaced you to become the world's #1 container carrier. That was back in 2022. But some are looking at the rates of expansion that rivals plan and suggest that you could drop to third place. I wonder, can you tell us what your thinking is on that and the extent to which that matters or influences strategy?
I think for us, our strategy is very clear, and it is not to grow share in shipping or to retain #1 or #2 places. Our strategy is about diversification along the supply chain and into logistics in businesses that create more value for our customers and that provide us also with more predictable and resilient earnings, and that's what we will continue to do. We are in a situation today in the shipping markets where actually market share has very little bearing on your ability to generate margin or superior financial returns. And given the volatility that there is in this market, I think this diversification strategy that we have continues to be our focus, and therefore we're not too worried or interested in the relative evolution compared to others' orders or order books or market shares.
Okay, so Vincent, if the focus of expansion is around logistics, creating value, you say, for shareholders, and just like the former CEO, we used to talk about the focus on the logistics side. Talk to us about DB Schenker. There was some surprise in the markets when you expressed confidence or some interest, at least, in that business. Where have you got to on that? Are you still bidding? What are your chances of getting hold of that German logistics asset?
Well, there is nothing new really compared to 3 months ago when we announced that given the size of DB Schenker and the alignment that there was with, or the potential alignment that there was with our strategy, we would look into this process and figure out whether this was a good fit for us and the asset could be purchased at a price that did make sense for us. This process is still underway. And there is nothing really new since then that we can share.
Yep. Where else could you be looking, Vincent? The European story is getting more and more interesting in as much as it looks like we've got a ports crunch as well. I'm wondering where you see the opportunity in the logistics chain right now. Where are the biggest crunches and where are the biggest problems that need to be resolved?
Yeah, I think there are two main issues that our customers are facing. One is just the fragmentation of the offering, which means a very vulnerable supply chain. And we've seen this during COVID. I think a lot of customers are seeing it right now with the disruptions in the Red Sea, and they're looking for partners that can expand their offering and that can actually take care of bigger chunks of their supply chain and guarantee outcomes that they otherwise have a hard time getting to. That's the one thing. And the second is still the digitization, the technology, the integration of data so that they have a better understanding of the flow and a better management there. And then lastly, maybe also decarbonization and the green agenda continues to be also a very, very prominent part of the conversation.
All right, Vincent Clerc, the CEO of Maersk, thank you so much for your time this morning. Coming up on the program, it's back to the macro as the Federal Reserve and the markets continue to digest Jay Powell's comments. We'll discuss that with our guest coming up next. This is Bloomberg.
The whole game plan is basically unchanged. We're going to keep rates here until we're highly confident that we're going to get inflation down to 2%. no hint whatsoever of a rate hike.
I think there's a lot of relief here that the chairman stayed true to what we've seen from this chairman.
I think Jay Powell was particularly disciplined here. I think he stayed on message very well. There's a clear bias towards easing, and he stuck to that.
They've left wide open the question of why has progress been less than they expected on the inflation front.
The Federal Reserve is not living up to the commitment on inflation that other central banks are.
Let that tight policy work for longer. I think that's about as far as they're ready to go today. That's hawkish in May. We'll see what hawkish might look like in June.
This is really good for the markets because here's a Fed that's telling us, look at the longer term. Look where inflation was and look where we've gotten it to. Don't worry about the last couple of months. We'll see what happens there.
Some of the guests on Bloomberg Television reacting to the latest Fed decision and Jerome Powell's comments. Let's get a little bit more analysis this morning. Althea Spinozzi, head of fixed income strategy over at Saxo Bank, joins us. Althea, pleasure to have you on the program. I'm going to leave the rate story to Guy and Anna. I'm really curious about the quantitative tightening piece because it feels like that was what was new when it came to this commentary from Jay Powell and his colleagues. What do you make of that slowdown in June? Is this going to be a real shift in terms of what the bond market and how the bond market is able to cope with the changes?
Well, Kriti, I don't think it's going to be a massive shift. And the reason is that while the Federal Reserve is going to taper quantitative tightening, on the other side, we have the U.S. Treasury maintaining coupon issuance at very high level, to the same levels that we've seen in the first quarter of the year, with the exception that in net terms, this quarter, we are going to see a net coupon issuance, which is the highest we've seen since 2022. So I think that the message that came out from the Federal Reserve yesterday is quite dovish. And the reason for that is that the quantitative tightening has been slowed down to $25 billion a month. Policymakers were talking about $30 billion cap, and that would have been enough to preserve T-bills within the Federal Reserve balance sheet. By lowering it to $25 billion a month, the Federal Reserve is basically preserving also a chunky part of coupon-bearing U.S. Treasuries. And the question at this point, is it a coincidence that that announcement came just after the U.S. Treasury said that elevated coupon issuance is going to stay here for the next couple of years? There is a real question about monetization of the U.S. debt here.
So, Althea, translate that then into what that actually does to the yield curve, to the shape of the yield curve. How do you see this playing out?
Well, the front part of the yield curve is going to hover around 5% because with quantitative tightening tapering, well, the Federal Reserve is going to cut rates later than expected. Powell really dismissed the chance for imminent rate cuts, challenging the dot plot that we just received in March, showing 3 interest rate cuts. But the long part of the yield curve is likely to continue to rise. The reason being is that there is going to be some relief in duration because the Federal Reserve is tapering QT, but really we are getting a lot of U.S. Treasury coupon issuance. The 10-year auction size is the largest on record that we have ever seen.
Althea, good morning. How should we think about QT alongside more standard monetary policy? Because the Fed likes to say that what they do on QT is independent of the rate story. You've linked it to the bond market, but link the two for us.
Well, I don't think that they are really independent. And normally, the Federal Reserve begins to slow down quantitative tightening when is looking to ease the economy. And I don't think that it's a coincidence that they start from QT tapering this time around as well. The problem with rate cuts this year is that we have a U.S. election coming up, and we know that the Federal Reserve is not going to be inclined to cut rates in the middle of the election campaign. So September is out of the question. July, it's too close to quantitative tightening. We are left with November and December. But Anna, yesterday, Powell said that the economy remains really resilient and doesn't warrant interest rate cuts. So it might be that we don't get any rate cut for this year.
Why do you make such an explicit link to the politics, Althea? We heard quite a lot of pushback from Jerome Powell. I suppose you'd expect that. But we did hear that pushback yesterday from the Fed around, not going there, not thinking about the politics.
Well, yes, the Federal Reserve is definitely apolitical, but is formed by people that are going to vote in the U.S. election. And when we try to pinpoint at what the Federal Reserve is doing, well, the Federal Reserve is tapering quantitative tightening when bank reserves are almost around $4 trillion. They are nowhere scarce. And by slowing down QT, what they do is easing slightly financing conditions. Why do they do that in June when the election campaign is going to start in September? I just believe that they do that because they are afraid of something breaking, and QT is just a way to ease financing condition and have a smooth sailing toward the U.S. election.
Althea, the Fed seemed quite comfortable with the idea that inflation is still tracking lower. Do you think how important is inflation, do you think, in the Fed's thinking right now?
I don't think that the Federal Reserve is thinking about inflation enough. We have received quite bad numbers in the past couple of months that they are indicating that the inflation is bottoming at a very elevated levels. And there are signs of probably a rebound from this level. So the problem that the Federal Reserve has right now is that bond performance is driven by inflation. If the Federal Reserve doesn't resolve the inflation part, the bond market will do that by taking the situation under control. Already right now, if we look at inflation premium, so the premium that investors are demanding to hold the U.S. treasuries is at a level that we have seen only 8 times since 1980s until today. It means markets perceive inflation risk, is demanding a premium, and if the Federal Reserve dismisses it, they will demand a much higher premium.
Okay, Althea, so what's the right trade? Give me the scenario. You painted a scenario. You've made that really clear. What do I do if I want to position for that trade?
Remain very cautious, try to pick duration and quality carefully. You want to stay in the front part of the yield curve. If we take the 2-year U.S. Treasury, we need yields to rise well above 11% within a year in order for that position to provide a loss. And when we look at credit risk, it's very good idea to remain in high-quality companies, looking to secure a pickup over U.S. Treasury, but not extend duration too much.
Don't expand duration too much. I'm hearing that trade a few times over the last 24 hours. Althea, thank you very much. Althea Spinozzi, Head of Fixed Income Strategy, joining us from Saxo Bank. Thank you very much indeed. Let's get back to the corporates. We've just been talking about the Novo Nordisk continues to ride the Wegovy trade as Europe's biggest company boosts its outlook. We're going to talk about that stock. We're going to talk about so many other stocks that we have reporting numbers this morning. We will do that next. This is Bloomberg.
Welcome back to Markets Today. We are 17 minutes away from the start of cash equities trading. The futures picture looks fairly mixed, actually, for European stocks. We've got a number of earnings reports out this morning. We'll see how they factor in to the opening trade in around 17 minutes' time. Joining us now, though, to look at some of the macro themes, Market Live's Ven Ram with us this morning from Dubai. Ven, very good morning to you. So the Federal Reserve, Jerome Powell, keeping hopes alive for an interest rate cut and tweaking QT a little bit in that direction. What was your big takeaway from the Fed? Did anything change for you, crucially?
Morning, Anna. I think that the big picture is still the same. The Fed still thinks that there is room for them to cut rates later in the year. I think it's a pretty fair estimate, given that we still have 8 months left on the calendar. Powell remarked yesterday that there are broadly two paths to the Fed cutting rates. The first, obviously, being greater confidence that inflation is converging to target, and the second being weakness in the labor market. Well, they're not going to get the confidence on the inflation front anytime soon, so we need to see how the labor market fares in the months to come. What we have seen is that the jobs market has lost some momentum. There is no question about it. But on the whole, it's still healthy. I mean, you've got to admit that prints that we have seen show the economic resilience. Historically, what has happened is that we don't typically go into a recession gradually, but rather abruptly. It all falls in one fell swoop. And so it's still possible that we could get 1 or 2 rate cuts, which is roughly what the markets are positioned for, and which is the outcome that Powell would have wanted last night going into that meeting.
OK. And then we saw some movement in the yen. After we got the statement from the Federal Reserve, we saw some movement in the yen. Perhaps it was intervention. I see a Trader Talk piece this morning saying this yen intervention looks doomed and desperate. Are we seeing more intervention? Is that what it looks like to you, Ven?
Well, I mean, yesterday's moves, in fair context, I mean, the Treasury yield swung a lot. I mean, like 11 basis points on the day. Given those kind of moves, it's not hard to see the yen moving as much as it did. But I think the big picture is that, too much of the market getting caught up in whether or not the BOJ or MOF were in the markets. I think that is kind of distracting the wider conversation. The big picture here is what happens to the yen. And I think that the markets are still underpricing volatility. The yen markets are thinking the yen will snap back to 150 in 1 month's time. I think that is underpricing the volatility in the market. So it could go on for longer than people think.
All right, Ven, well, don't go anywhere. I want to stick with that currency conversation. But before we do, I want to bring a chart to everyone's attention, a chart that very specifically caught my eye when it comes to the dollar in particular. And this is really interesting. I'm really excited. I got so excited about this that I decided to stand up to really show you what I'm talking about here. The dollar positioning is really important going into this story. Now, of course, we know this kind of higher for longer narrative from the Federal Reserve suggests that there are going to be those bullish dollar bets. But just look at how bullish people are getting. And that's why I want to bring your attention to this bottom panel here, which shows this green on the screen, the surge that you are seeing. It is your most bullish people have been all the way going back to 2017. This is even pre-COVID. It really speaks to this idea of just how much the Federal Reserve is changing this long dollar bet when a lot of people are saying this is a crowded trade at the end of the day. Compare this, by the way, to what you're seeing in this acceleration during those supply chain cuts, that post-COVID surge you saw in the dollar. I'm curious what that means. Ben, I'm going to bring it right back to you. Is the bet on the dollar still very much driven by interest rate differentials, or is this a capital flow story at the end of the day?
I think it's very much still an interest rate differential story, Kriti, because if you look at the markets are now thinking 35 basis points of rate cuts are possible. Now, what happens if the economy proves to be extremely resilient and inflation proves sticky? In that case, I think the dollar yen, the dollar in the broad sense has got more to go. But what happens if the economy caves in and then so the dollar, I think in that scenario, the dollar is kind of overpriced. And I think that there is a bigger scope for correction in the dollar than there is room for it to run up. So I think there is an asymmetry in the kind of positioning for the dollar. And I do think that the risk reward is also asymmetric from here, i.e. the risk of a correction in the dollar is bigger than the risk of it running up too much from here.
All right, Ven Ram of our Markets Live team, we thank you so much for a little bit of a spotlight on the currency picture. You can get more from Ven and the rest of the team and get up-to-date analysis on MLIV Go on your Bloomberg terminal. Very easy function. You'll get real-time data. In the meantime, let's continue that currency conversation as well, because as we were talking about the dollar, we're already seeing some moves this morning in the euro, the yuan, and of course the Swiss franc as well.
Swiss franc is really interesting. So the Swiss have already cut.
Yeah.
Surprised us. Didn't surprise everybody, but certainly surprised many with that cut. So this morning we get data out of Switzerland. The CPI number is coming at 1.4. Now, the prior number was 1. The survey was 1.1. This is a hotter than anticipated inflation print out of Switzerland. Stickier than anticipated inflation. Just flagging the risks of central banks going early on this story. This may be a blip. This may be a one-off. Who knows? But it just, again, just kind of fires a little warning shot across the central bank's bows about, do you want to go early with cuts?
Yeah, it was really interesting. I remember a conversation earlier on this week with one of our guests who was saying inflation, he was talking about the US, but you could apply it elsewhere. Inflation is not sticky, it's stuck.
Yeah.
And that's an interesting one. If the market starts to come around to that way of thinking, then that changes our expectations, obviously, for rate cuts.
Also, how do you trade it? I mean, Ben there was talking about it as very simple as still being an interest rate trade, but if the Swiss franc is kind of your alternative as a funding currency to the Japanese yen, and then you see moves like this, which may be a one-off, maybe more sustained, what's your alternative? If you've got the yen off the docket, you've got the Swiss franc potentially off the docket in the long term, where else do you go?
So this is the problem with the funding trade. So these are funding currencies that are being used by a lot of people. There are others out there, but there aren't many out there. And you're starting to see volatility in the FX landscape in a much more pronounced way than we've seen over the last few years. Do these carry trades still work in that environment? And if we get into a greater or a more volatile environment, and the Fed's kind of hinting about that. We are data dependent now.
Yes.
So that would imply more volatility. Do those trades still work?
We saw plenty of bond market volatility whilst there was no FX and no equity market volatility. So now maybe we get it in FX as well. And to your point, Guy, some colleagues writing on the Bloomberg terminal this morning about how more data dependency leads to more volatility because every piece of data can change your thinking.
And the other side of that trade as well, to your point about the volatility, is, yes, we talk about the Swiss franc and the Japanese yen as well. The other side of that very popular trade is the Brazilian real and the Mexican peso, right? And if the concern around the euro, for example, and even the pound is what does a Fed that doesn't cut for a while mean for these currencies, that squeeze gets even more acute in some of the EM stories, especially in Latin America, which, by the way, is far more commodity exposed, more copper exposed as well, economies, not to mention the oil story as well. So there's, to your point about that kind of easy carry trade disappearing, here's a great example.
Absolutely. Let's switch asset classes. We're going to go from what's happening in the world of foreign exchange to the world of equities. There is a lot of equity news out there this morning. Joe Easton is having a busy morning. Let's see what he's kind of taken away from it. Over to you.
Morning, guys. So one of the busiest sectors today is the financial space. Lots going on there. We have got earnings out of Stand Chart, smashing expectations for the dual-listed Hong Kong and London bank today. 1Q adjusted pre-tax profit above $2 billion versus expected 1.6. A lot of this driven by the wealth and retail business. That sector did see an 8% gain for Stand Chart, according to the report, and only a very small charge on the Chinese real estate. That was an issue. Would there be a big impairment on that sector? Doesn't seem to be the case. So that looks positive there. Then also in Spain, Madrid reopening following that holiday yesterday. And yesterday we did get details of BBVA's takeover of Sabadell. And we've brought the numbers up here. So every share for Sabadell, 4.8 of those will be exchanged for one share of BBVA. Now, BBVA says that is a 30% premium, but our M&A reporter tells us that some of that is already priced in, so the premium looks to be about 17% according to her calculations. So keep an eye on that one. The merged entity will have around €1 trillion worth of assets according to the two companies. Finally, we've also got numbers out of ING beating expectations as well. Here's this one on the screen. They are doing a buyback as well. The buyback there is €2.5 billion, so a chunky one out of that one. All of those stocks should get a boost, but take a look at Sabadell, almost doubled already over 1 year as that deal news priced into the market. Then we're going to move over and look at Novo Nordisk, the obesity drug giant, smashing expectations as well. Ozempic sales of 27.8 billion Danish kroner in the last period, according to them. And in terms of Wegovy, 20,000 people a week now joining that drug in the US versus only 5,000 5,000 a week at the end of last year. So explosive growth in both of those obesity drugs. And as a result, they have upped their guidance for sales for the year to as much as 27% from as low as 18%. So a big one there. The 3-year chart on Novo looks very impressive, of course. We can see that gain, a 287% rise for Novo Nordisk, given those obesity drugs. And as we've been covering before on the shows, that does make Novo the largest company by market cap across the entire European space, bigger than LVMH, ASML and Nestle as well, just showing how strong that company's been over the past few years. Finally, we're looking at Maersk, numbers out of them, staying in Copenhagen. A positive reaction expected from this one. We've seen some gains on Tradegate already. They say that container trade volumes will be at the upper end of their previous guidance, according to Maersk today. Now, the issues in the Red Sea are expected to continue for the rest of the year, but that has had the positive impact on rates, and that's fed through into their profits, which are beating expectations. We've seen a gain this year, but if we look back across the pandemic period, we've got a long way to go to get back to that peak when we had all the supply chain disruption. But for now, the earnings on Maersk look pretty positive, and as I say, gaining on the Tradegate exchange this morning.
Joe, thanks very much. Our equities reporter, Joe Easton, with a host of companies to keep an eye on, from financials to energy names. Interesting debate going on the T-Live blog around Shell about whether they continue to keep up this pace of buybacks, given they've done so much for so long and the balance sheet looking increasingly healthy in the eyes of some. So we'll see what analysts come back with on that.
The French finance minister's out on the tape.
He's certainly catching our eye.
Total is not going to move. The primary listing must stay in Paris, he's basically saying. Another strategic asset for the French. It has implications for Shell, I would have thought.
Can they do that? Can they?
Yes.
Okay.
I'm pretty sure they could. They could make life very difficult. If you moving jurisdictions is very difficult. Moving your headquarters is very difficult.
Okay. Lots of questions coming up. We're going to answer them all. It's the market open. Futures are pointing higher, at least when you look at the FTSE 100. Your top 50 not doing as well. Stick with us. This is Bloomberg.
Couple of minutes to go until the start of trading here in Europe this morning. US stocks did this and then they did this yesterday. So we basically kind of ended up where we started. And therefore, for European markets this morning, the guide, I think, is relatively limited out of the States yesterday. So what I think is going to happen here is that single stocks are going to have quite a disproportionate impact on what we are watching. London looks like it's going to be fairly positive. We've got a price in Shell this morning. You've got a price in Standard Chartered, which looks like it's going to have a decent bounce. Novo's obviously in the mix. You've got to put Maersk in there as well. And there's a lot of big names with a big impact today, plus a few ex-divs as well.
Yeah, a few ex-divs. And worth thinking about where we were yesterday, because we've got a lot of energy names reporting this morning and in focus, and energy stocks were weaker on the back of that drop of oil prices that we saw on inventories, and also geopolitics. Some of our reporting, colleagues at Bloomberg talking about what could happen between the US, Israel and Saudi Arabia, all of that adding up to a slightly lower oil price.
I'm really interested in the Maersk story here, because literally 3 months ago, when we had this conversation with Vincent Clerc, which we just had, he suspended buybacks, suspended guidance. It was a brutal drop in the stock price as well, as is expected off those Red Sea tensions. Do you recoup the move coming off of this kind of brighter demand picture, this brighter demand story, and really kind of saying that these Red Sea tensions, they're here, they still exist, but perhaps not going to be as much of a weight as previously.
And they flatter the business, to your point, in terms of the demand story. And then in answer to my question about pricing and contract negotiations, they flatter there as well.
Absolutely. How long does it continue for is probably the most important determinant here. 20 seconds to go. Keep an eye on the banking sector as well. Standard Chartered looks like it's had a good time in wealth management. That's going to probably boost its share price this morning. We've already seen that in Hong Kong. ING sounding really quite positive as well. So buyback. Kriti's excited about the buybacks. Buybacks are a big feature of the landscape once again. So here we go. European markets are opening. A lot to price in. We are anticipating that the FTSE 100 gets a little bit of a pop. We'll wait for that to come through. It's starting to turn a little bit more green. But we're also sort of going into May, and I wonder whether there's some jitters around that as well. But at the moment, I think probably everybody's focused on the bottom-up story. What is happening with the single stocks? We're beginning to climb a little bit in London. What does the early action look like?
In terms of that early action, just a little bit of upside then for the London market, as you suggest. Obviously, a lot of markets were closed yesterday in Europe and elsewhere, so that'll add to the divergence between London and the rest today. In terms of those energy names, then, looking to see if we get movement, it looks as if we're a little
Shell
bit
coming
lower.
in very hot.
Okay.
At the beginning of the session, index move here, one of your biggest top performers, higher by 1.5%. So that's moving the docket, but it's a lone wolf there, because you look at some of the other energy names, they are all in the red. So to your point, from a sector perspective, not correct. Which I wonder if is kind of a bit of a macro read-through as well. You are seeing some of the banking names higher, though, as well. HSBC is your second biggest index contributor to the FTSE, coming right after Shell. So is the London Stock Exchange. So there's some interesting kind of financial names in play here in terms of your best performers this morning.
Vestas is a little soft. We're going to talk to the CEO tomorrow. Looking forward to that. But that stock certainly looks very soft. Novo is understandably the biggest kind of points game, but ING's in there as well. HSBC looks like it's up as well. I wonder whether that's... So Hong Kong... The Hong Kong session really stands out to me this morning. It was very, very strong, and it looks like you're getting some divergence between the Hong Kong market and other major markets around the world, which I think is worth paying attention to. And HSBC may be a beneficiary of that this morning, plus also what Standard Chartered had to say this morning too. Luxury is popping higher. Pandora's up quite strongly. It's had some very strong numbers as well this morning. But weakness in energy. Even Shell is now down by 0.5%. So despite the news they've delivered this morning, that stock is weakening in line with the rest of the sector. Now, the rest of the sector is down by much more, but it is still down. Yeah, actually, the London listing of Shell looks a little stronger, so we'll dig into the details there. But AP Møller Maersk in focus as well. That stock down by 1.5% this morning, and we've, of course, spoken to the CEO earlier on. We talked about what he had to say about global container rates and about the Red Sea and the extent to which that all persists. The impact from the Red Sea conflict will last most of 2024, and he said that certainly into the second half of this year, that was his expectation, that's where you'd see the impact. And Maersk raising the lower end of their profit forecast range. That not having a positive impact on the stock, though. That went down by 2.5% this morning. You're right about Shell. Looks like it's the other listings that are moving that story down, but the rest of the sector is soft. But yes, no, Shell in London is currently higher by 1.33%. I apologise for the error. Where does this take us net-net? I think it's really hard to kind of pull some stories out of this that give us a clear sense of direction. What is the read across here? The financials actually sound quite positive, so that's a fairly solid foundation for the market. Elsewhere, I think it's a more murky picture. I think the Maersk story is difficult to navigate, to excuse the pun, in terms of what actually it tells us. I think there's a lot of geopolitics folded into that story, and the oil story I think is all over the place. I think it's really hard to get a handle on what is happening with the oil sector right now, with this kind of Saudi story hanging over us. We potentially could see a deal between Saudi, the United States and Israel. What would that mean for the oil story? So I think that's a difficult one to read. Is that an overhang? Is the geopolitics still an overhang in this market in terms of kind of if we do get that either normalization talks or do we see that deal, is that then ultimately a positive? Or does it really ultimately just come back down to the monetary policy story? Where is the relief rally on the idea that maybe there will not be a hike? At least this is what Chair Powell had to say on the subject. Take a listen. I do think it's clear that that policy is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that that the data will have to answer. I think it's unlikely that the next policy rate move will be a hike. A little bit more on that. Let's bring in on the markets Kevin Thazet, Portfolio Advisor Investment Committee member at Carmignac. I'm hoping I'm saying all of that right. I apologize, Kevin, if I'm not. Let's get right into the analysis and right into the monetary policy there. In particular, we're talking a lot about this kind of maybe not a hike on the table, but perhaps a cut getting further and further priced out. Is this good news or is this bad news? How are you thinking about it in terms of the tailwind to the equity market?
Well, I think that Mr. Powell last night gave something close to a perfect speech. On the one hand, he maintained credibility, so stating that cuts would likely be further out, and he's postponing the decisions on that front in the wake of still solid economic data, solid or higher than expected inflation data. And on the other hand, he's been pushing back on the hikes, which was a growing concern for markets. So all of this, I think, gives a very favorable backdrop altogether for risk assets and for equities notably.
What would bring that kind of hiccup to the forefront? If the monetary policy is kind of on pause at the moment, which I think is a fair way to look at it, where's the next growth catalyst coming from?
Yeah, well, it could be slower economic data, or not as good economic data. And I think that this would be pretty well digested by financial markets, really, and by risk assets, really. What that is, because in fact, market expectations have adjusted. What is expected for this year on the U.S. monetary policy front, one cut at best. So I think, again, on that front, the job has been done by financial markets in adjusting as per what the Fed might be doing. So should we be getting any kind of signs of a deceleration in economic growth or not as good economic data, then we would likely see kind of increasing pricing of more cuts, which will be well received, I think, by markets as well and by risk assets, even more so given the starting point we are at with, again, a solid economic backdrop.
What if the cuts are not because we've got a solid economic backdrop? It kind of feels like the Fed is waiting for a recession. The idea that the Fed can land this economy softly is becoming more and more difficult to entertain, isn't it?
Yes, I mean, it's always been a tough sell, let's put it this way. We have collectively all been very doubtful as per the possibility of a soft landing in the US. But one has to admit that so far, this is what is actually being planned out, and that's what is unrolling these days. So, here again, I think that let's say the central scenario is more that of, insurance cuts, and those insurance cuts are being postponed for sure. But again, those are not kind of an emergency phase. And so all this is, again, quite favorable for credit, for equities altogether.
Are the earnings strong enough to justify further equity outperformance, do you think?
Well, again, I mean, if I'm looking at what is expected in Europe for this quarter, the earnings have adjusted significantly on the downside. And here again, what is important to be looking at is what's being integrated. And there's, I'd say, I don't know if it's a fair bit of pessimism, but I think there's quite some cautiousness out there. So, if we kind of look at, let's say, analysts and investors which have adjusted on the earnings side, the potential for, I'd say, a decent economic vintage for 2024 for the US, but also for Europe, potentially for China as well. All this would mean that the earnings trajectories going forward shouldn't be that bad across the board.
Kevin, are you concerned, or maybe concerned is the wrong word, maybe there are opportunities in it? Are you thinking about how Europe and the US and central banks there, the rates will decline at different paces? I'm quoting here a line from the OECD this morning, flagging that the EU and US central banks rates will decline at different paces. What does that mean to you in your portfolio?
For sure, I'd say, strong upward movement we have seen on risk assets for the past 6 months or so was fueled by two strong factors on the from top-down basis. One was this synchronized economic recovery or synchronized economic growth for 2024. I think this is still on the cards. And I'd say the second lever was that of a synchronized monetary easing. For sure, with, again, those higher than expected or even reacceleration in some inflation measures in the US, what is likely ahead of us is some form of divergence in monetary policies. So with the Fed, remaining on hold for most of this year, what our take is that they will not move before election, not during election, so this kind of pushes back its potential cuts in December. While the ECB might be cutting rates as soon as June. I think Mrs. Lagarde has been pretty clear on that front. Initially, I don't think it's going to harm too much. Obviously, it puts some form of a cap or a ceiling or floor as per how low European rates can go, because it will feed into the euro-dollar, and there's some transmission between this weakness of the euro and inflation for sure.
OK, and we know about interest rate differentials clearly influencing where the yen is trading right now, Kevin. I noticed in your notes you talk about the yen and you talk about in whose interest it is to shore up the yen and not have it weaken further. Would you expect to see other players then in an intervention, not just the Japanese?
Yes, I mean that's it's something we saw in the late 90s with Minister Rubin from the US intervening as well, so as to kind of shore up the yen. Clearly, it could be something that could be happening again.
Kevin, great to catch up. Thanks very much indeed. Kevin Toze, Portfolio Advisor and Investments Committee member over at Carmignac. Let's take a look at the bigger picture here in Europe. Here are the main stocks that we often follow, the core six. Novo Nordisk, obviously, one of the stories that is standing out this morning. But it's interesting to see the reaction that we are getting in some of these stocks this morning. ASML is down pretty hard. But look at Novo as well. I think this is fascinating. This stock is, as you can see on the screen at the moment, weakening. There are very few of these major stocks that are higher this morning. Schneider is also soft. Nestle is down. There's no kind of obvious sort of growth value narrative that seems to be developing here either. Ferrari is showing signs of weakness as well. So it's interesting how the market is taking some of these stock stories. Maersk is down this morning as well. It gapped higher a few days ago and is now fading that move. Let's work our way through some of the other names that we're watching. I think this is turning into a really interesting kind of granular story developing here in Europe. Joe Easton, over to you.
So we'll start with the banks, guys, because we have got a move in Sabadell over in Madrid, reopening following that holiday, up 7%. We got the details of that merger. It is actually trading well below the implied price, so perhaps some risk of execution on that one. BBVA coming down. It's a merger between sunny Alicante and Bilbao in the north, and it is getting a positive reaction on Sabadell at least, but BBVA is declining. In terms of the other big banks, Stanchart getting a 6% gain, much bigger than the rise we saw in Hong Kong. In fact, they are seeing some strength in the wealth management business, and ING rising following that 2.5 billion euro buyback this morning over in Amsterdam, up 5%, a big gain for that one today. Then in terms of some of those other Danish earnings, it's not just Novo today. We've got a bunch of other firms reporting. There's Novo, though, extending that decline now. It's down 2.5%, obviously a massive gainer over the past few years for the obesity drug maker. And Maersk actually declining. Most of the numbers look pretty positive out of them, but one trader pointing to a line on attributable profit, which is a specific number that they report, and apparently that one is weak, and we are seeing that stock declining 4% in Copenhagen. Vestas, a serial offender over on the Danish exchange, that one declining. That one's down 4% today. Wind turbines are weakening, but Pandora, charm bracelets, we can't get enough of them, can we? And they're also gaining in terms of Pandora stock today. It's up 4% following some strong earnings out of them this morning. A couple of other quick earnings to bring you on the final board. There's Shell, only up 0.6%, had a good run today. Hugo Boss over in Apparel, pretty strong numbers out of them, but not a huge gain. Teleperformance hit hard this year due to worries about AI encroaching on the call centre business, but that is rebounding today following results from them. Strong numbers. And Worldline also a serial profit warner, that one gaining. It's in the payment processor space, both of them in France today. London Stock Exchange, meanwhile, gets a gain. They are rebuying $500 million worth of stock from Blackstone, their former investor. Still has a big stake in them. They're rebuying more stock from that one. It's up 1%. It was up around 3% at the open. That one is gaining. In terms of chemicals, finally, we've got Bayer, a positive court ruling out of the German company. That comes from Washington, a court ruling against a almost $200 million ruling around one of their chemicals at the Monsanto business that was said to cause health issues. A court overturns that, and we are seeing a decent gain for Bayer, up 5% over in Frankfurt.
Joe, thanks very much. Joe Easton from our equities team. We're going to dig into what's going on at Novo Nordisk next. It's shipping 4 times more introductory doses of its weight loss drug Wegovy in the United States than at the end of last year. That's not enough, though, to shore up confidence in the story. Down by 2.3% this morning for that Danish listing. We'll discuss those numbers from Europe's most valuable company next. This is Bloomberg.
A bit more breaking data to bring you this morning. We have Spanish manufacturing PMI dropping onto the Bloomberg terminal. It comes through at 52.2. That's up from 51.4 and above the 51.4 that economists were anticipating. More evidence, perhaps, of a manufacturing rebound that is occurring. More strong data out of Spain, which will cheer Kriti up. But it's a slow progress story when it comes to the manufacturing side of things. Talking of manufacturing, let's talk a little bit about Novo Nordisk this morning. So, in theory, it's outperformed its first quarter result expectations. So the Danish pharma giant announcing that it's going to be quadrupling the number of patients starting the weight loss drug Wegovy in the United States. But there looks like some issues around pricing. We've got a stock that is now down. So earlier on, the indications were that it was going to open higher. Now it is down and adding significant weight to the KFX this morning. Ashley Furlong joins us now to give us some sort of assessment of what is going on and to maybe sort of clear this muddled picture up for us. So, why is the stock down?
It's increasingly becoming sort of a supply issue. We've seen with Wegovy the estimates, the sales for Wegovy slightly missed estimates. And I think we're seeing that, everyone's looking, can these drug makers supply enough product to meet this insatiable demand? And the question at the moment is that they can't. And today, Novo Nordisk also said that the demand is expected to continue to outstrip supply for the coming months.
So that's the supply side of things, Ashley, which you rightly point out, and that seems to be an issue for them. They have increased their guidance on profit and sales. So what do we learn today about the long-term potential of these types of drugs?
So they're doing a lot of work to actually increase that supply and a lot of investment into the manufacturing capacity. So this year they plan to spend double what they spent previously in investment in manufacturing capacity. And as we've heard, quadrupled starter doses every week in the US compared to December. 5,000 people starting on Wegovy in December, 20,000 starting now every week in the US. That's quite a significant increase. And they're hoping, obviously, that they can continue to ramp up supply to meet that demand.
Can we talk a little bit about pricing here? Because if there is this demand, this insatiable demand, why are the prices decreasing at a time when the competitor, Eli Lilly, seems to be doing just fine?
We'll be seeing sort of increasing, governments and sort of people who would reimburse these drugs looking at the prices and questions about whether they can continue to actually pay those prices. As we've seen also a reimbursement in the home country as well, questions about whether it'll continue to be reimbursed at the same rates. So I think the drug makers are feeling pressure to lower those prices.
Yeah, certainly in the United States it's becoming quite heated, isn't it? And I noticed in our Big Take story, I did mention yesterday about how they dropped prices in their home market, as you referenced, to try and neutralise some of the politics there. What's the rivalry with Eli Lilly like? Because they seemed a little later to the party, but then people impressed with their numbers. So where do we stand
Exactly.
on that?
And Eli Lilly's stock has soared just after they posted results earlier this week and also raised their guidance. At the moment, with demand outstripping supply, there's space for them both. There's not enough of these weight loss drugs on the market, and people want them. So there's competition, obviously, but I think in the coming years that's something that's obviously going to be very closely watched to see who comes out top.
Expectation management is really important, and we're in a world, as you say, that we are supply constrained. The market is extrapolating. How difficult is it to extrapolate on what is going on here? It's really interesting. You can compare and contrast Nvidia and Novo really easily. They're both supply constrained. We don't know ultimately what the potential of these markets could be. We know it's going to be enormous, but the exact nature of the enormous bit is really hard to pick.
Well, as we've seen, Bloomberg Intelligence says $80 billion market annually by 2030. They think that might be conservative now. And there's many other drug makers, sort of knocking on that door with their own obesity drugs, and as well as Eli Lilly and Novo Nordisk coming up with different sort of products, oral products, things that might be more sort of palatable for patients.
Hard to pick. but certainly still looking good, despite the little wobble that we're seeing certainly this morning. Ashley, thank you very much indeed for providing some clarity, Ashley Furlong, on what is happening with Novo Nordisk. Of course, you do not want to miss our interview. The CFO of Novo Nordisk is coming up just after 9 a.m. London time. We are going to be hearing from the company's chief executive a little later on in the day. It's a busy day for Novo Nordisk, and we have definitely got it covered. Plus, we've got other news coming out of the pharma sector as well. Moderna's going to be joining us too. The CEO, Stefan Bancel, is going to be joining the team a little bit later on, 12:30 London time, for that conversation. Listen to Stefan. He has many interesting things to say. So there's lots of great insights coming up on the pharma sector throughout the morning.
Lots on pharma, lots on banks. The earnings don't stop. Let's go to the banks next. Standard Chartered posting first quarter earnings that topped their estimates as after its traders collected a windfall from tumultuous credit and commodity markets. ING, on the other hand, meanwhile, announcing a €2.5 billion share buyback for reporting a first quarter profit that beat estimates. We spoke to the CFO earlier and got his take on the macro and how it influences his business. Take a listen.
Federal Reserve maybe delaying rate cuts. That would have a read across to the ECB decision making. So the market expectation is that June will be the first rate cut. But I think the shape of that rate cut will be more benign than perhaps even the market expect. We believe we can operate profitably and in a structural way when rates are at 4%. And we expect that we can operate quite profitably even if rates comes down to 2.5 to 75.
All right, joining us now, Bloomberg's Tom Metcalf. Tom, we just heard from the ING CEO there. Let's start there. The ING number is interesting. Big buyback, though. Is this just catch-up? Is this a one-off? How are you viewing it?
But ING have been coming out with some big buybacks for a while now. You know, for the size of that bank, as you say, 2.5 billion, not bad. So no surprise shareholders have been reacting well over the past few months to that sort of policy. And I thought his comments there were just, you know, really interesting, really just convey why banks like ING are doing well at the moment. You know, this rate story, the fact rates will stay higher for longer. They're going to be making plenty of profits. And it's interesting to see kind of the range he gave there as well, right down to 2.5%. He's seeing looking pretty comfortable.
So that's the story around that particular business, around ING. What about Standard Chartered then, Tom? We've got a beat there. Wealth management, it seems, a bright spot.
Yeah, very strong beat, actually. I think shares are now up 6-7% in London. And, yeah, you had the wealth management. They're bringing in new money, bringing in those wealthy clients that all banks are trying to chase. And of course, the other thing would be the traders. So then the last few quarters, the traders at Standard Chartered, maybe somewhat more unheralded than those at Goldman Sachs, but they're doing a pretty good job and really push those earnings up.
Brutal over at Barclays. Talk me through the job cuts.
Yeah, so this is, you know, we knew they were coming and they were started yesterday, basically. So several hundred, and this is right across the investment bank.
Yep.
So, you know, it comes back to that very tricky situation that Barclays are in, right? Like, they want to stay as a global investment bank. It's a pretty hard message to be selling when, guess what, you're chopping 300 or so people.
Very quickly, it feels like three different banks, three different stories. Is there a takeaway here that we need to know from this morning's bank deluge?
The takeaway is you've got to watch every single earnings individually.
So basically be a Tom Metcalf.
Just be across it. That's the really interesting thing about European banking, I think, is, you know, we've got an acquisition story in Spain right now with BBVA and Sabadell.
Oh, we are well aware.
Yeah, and it's a completely different story when you swing, you know, that's in Southern Europe. You look at how different it is in Northern Europe. So everything kind of shifts. Obviously, generally a higher rate environment in
Tom, thanks very much. Bloomberg's Tom Metcalf with a host of corporates reporting from the banking space. He's had a busy week. He's joined us a few times and we're very grateful. Thanks very much, Tom. Coming up on the programme, shelling out. Oil major Shell keeps up the pace of share buybacks as first quarter profit drops less than expected. That was the key question going into these numbers. Would they keep up that pace? And they seem to have answered that with a yes. The stock is moving higher in London, and maybe that's the listing to look at today, given some markets were closed yesterday. We'll be back with analysis. This is Bloomberg.
This is Markets Today. We're about 30 minutes into the European trading day. Kind of a mixed picture when you look at some of these earnings stories. There's a lot to digest and no real read-through across the board. So let's dive into them. Maersk is catching all of our eyes. I have to start off there. There seems to be a lot of pressure on Danish stocks despite this move and positive numbers, it seems like, from Moller Maersk and from Novo. But let's start with Maersk.
So what I think is interesting is about Maersk this morning is that there was a gap higher on the 25th, which we almost filled now in terms of the move on the downside. So you just think about the kind of the round trip that Maersk has been on over the last few days. We're kind of back to where we started. So it's going to be interesting to see whether this move extends or whether this is simply just a kind of round trip, little expectation coming into the stock, you get a boost, and then you fade that move. But Danish stocks more broadly under pressure. But as Anna's been pointing out, the bulk of the move on the Danish market this morning, and this speaks to the big take yesterday, it's just Novo.
66% of the weighting on the Danish index.
Yeah, and look at all the points
Novo
this morning.
Yeah.
There's some softness elsewhere. Vestas is down, Maersk is down a little bit, but to be honest, you can park that because it's all down to basically what we're seeing with Novo.
It doesn't really cut through, does it? I wonder on the Maersk side of things as well. Yes, there was an upgrade to guidance, but there's also this continuing conversation about M&A in the logistics side, and you know that's been the strategy for this business for a long time, to not grow on the sea but to grow on land, and the wider logistics story. I wonder if there's some nervousness around that and what that costs.
Yeah, the DB Schenker story. We asked the CEO about it. You asked the CEO about it, and he said, well, we have nothing new to update. Surprise, surprise.
So that must have been in the market. So he was quite positive about this the other day. Is that new? No, I don't think it is. Do you price that this morning? I don't know.
No, maybe not. Maybe not the thing that moves it, but certainly the weight is downwards this morning, isn't it? What else have we got then? We've talked quite a lot about the banking sector and the earnings coming through there. A bit of M&A to sort of spice up that sector.
Oh, I'm so obsessed with the Spanish banking story. It seems like we're still getting the proper pricing and there's an expectation at least that there will be some sort of return offer from BBVA, and that it'll be some sort of increased offer as well, perhaps lasting at least a couple of weeks.
But does that become dilutive? That's the real challenge here, is that there's quite... How do you make this actually make sense if you are going to boost the price significantly further from here, I think is the question that BBVA would have to answer on this. And how big a cost cuts would you necessarily need to generate in order to justify a higher price, and would that be politically palatable? Even with the deal at the current price, to make it work, you have to deliver quite significant cost cuts.
So
otherwise it's dilutive.
Politically palatable in terms of yes, I don't think the Sanchez government is viewed as very pro-business at the moment. I'm nerding out, bear with me, but I think the prospect of having a Santander-sized or similar to Santander-sized bank coming out of Spain, another one, is quite palatable, at least from an international perspective. So I don't know how that's viewed politically, to be honest.
We'll see how the Spanish government ultimately reacts to this. We'll see how Sabadell works its way through the story. Let's talk about Shell. The stock moving this morning. Strong Q1 beat, lots of buybacks. How sustainable is it? James Heron joins us to discuss. What is the takeaway this morning from these numbers? Is it a belief that this is a business that's firing on all cylinders, that can continue to deliver? What is the sense?
Yeah, I think so. The big change we've seen in the past 12 months is that gas prices, especially in Europe, have dropped a lot. But Shell's gas business is proving pretty resilient. So profits down a bit on year, as expected, but holding up quarter on quarter. And they've kept up the pace of buybacks. It really is a very sort of strong, dependable performance. Investors seem quite pleased. So what they're getting is, dependability after lots of years of ups and downs. COVID was a huge problem for them, and the dividend cut. And now they seem to be back to steady, pretty good returns. So, about positive overall, I think.
OK, so that's the story around Shell. What links, Shell and Total Energies both being talked about as potentially interested in moving their primary listings to New York. This generates a lot of chatter, this kind of story. And interesting to see the French finance minister out this morning talking to domestic TV in France, saying it's important that Total Energies' primary listing stays in Paris. What do we make of that kind of French intervention?
Yeah, I think it's to be expected. The French have a more interventionist stance when it comes to their companies. The reason Total is talking about this, and Shell also, is this valuation gap they have with their US peers. The Exxon and Chevron trading at much higher valuations. And the perception, at least certainly what Pouyanné said, explaining his rationale, is that because of ESG concerns, European financial institutions just aren't buying into oil companies. But this obstacle doesn't really exist in the US. So they think if they move to the US as a primary listing, they can get a higher valuation, which is what their job is to achieve, really. So.
Yes, you are speaking guys' language. The amount of PE and multiples. And big oil that we've been speaking about on this show. Talk to us about the other piece of this business, though. If I remember correctly, Shell actually helped drive the FTSE 100 to a record at the time a couple of months ago because of LNG nat gas revenue.
Yeah.
What's going on in their trading business?
Their trading business is doing pretty well. At the end of last year, they were reporting exceptional earnings because the LNG business now, because since the invasion of Ukraine, the LNG business has been making so much money because they can divert cargoes from lower value markets to high value markets. It's been really driving their profits. That's come off the peak, but they're still doing really well. They have higher volumes because they're producing a bit more, and they've resolved some maintenance issues at some of their plants. So really, the LNG business, which Shell has really invested into and is, I think, one of the biggest companies out there, is looking like a really strong long-term bet, especially as it looks like, Russian gas is going to be out of Europe for the foreseeable future.
Oil's at a 7-week low. Inventory data yesterday seemed to be the factor behind the latest move lower. What is happening in terms of the expectation around what demand is looking like at the moment? And kind of how do I think about a range now for crude? Is it 80 to 100? Is it 70 to 90? What am I looking at?
Yeah, that's a tough question. What's really changed, I think, is two things. The de-escalation in the Middle East.
Yep.
When oil looked like it was going towards 100, we had Iran and Israel shooting at each other. Now we've got talk about potentially a ceasefire in Gaza, although there's still a lot of obstacles remain to that. And then also the big shift in sentiment about the outlook for interest rate cuts and the economy has really sort of tamped down expectations of demand. But then what makes it difficult is those two feed into each other, right? Because as oil prices start rising, it makes it look less likely they can cut interest rates. But as they start falling again, the inverse becomes true. So there's a bit of a feedback going on there, and it's kind of hard to see where the equilibrium is. It seems more that it shoots up and then drops down and shoots up again, rather than finding a sustainable level.
OK, James, thanks very much. So Brent at 84.07, WTI at 79.59 this morning. Both of those up about 0.75% on yesterday's close. James Herron, thank you very much for joining us to talk all things oil this morning. We were referencing the Middle East there, so let's stick with that theme. Bloomberg has learned that the United States and Saudi Arabia are nearing an historic deal that could potentially reshape security in the Middle East. Let's get more on this really important story. Bloomberg's Flavia Kraus-Jackson joins us with the latest here. Flavia, good to have you on the programme. So what do we know about the details of any potential agreement here?
I mean, what we know is that the US and Saudi officials have been discussing the contours of a deal that, of course, many people will sort of remember. It was meant to be a three-way thing with Israel. And what essentially would involve is that the US would help Saudi Arabia to get defense and some of the weapons that it really wants, and the exchange would be a normalization between Saudi Arabia and Israel. This is something that, of course, before October the 7th was very much desired, and as you recall, also in an interview that Netanyahu gave with Bloomberg News at the time, he felt that the Palestinian issue was a box that had to be ticked so he could have this normalization with Saudi Arabia. Of course, October 7th changed everything, and everything was put on ice. And the main difference now is that what you're looking at is the US and Saudi Arabia essentially looking at a deal, and then it would be put to Netanyahu, who would essentially sort of have, the option to either sort of get in or not. But the main hurdle here, of course, is Palestinian statehood. That is just something that right now Israel can't contemplate. So I think we need a sort of degree of skepticism about the likelihood that this could go through. But the fact that now they're sort of talking about it, and it's been sort of 6 months because this was essentially a taboo subject for a while, is quite interesting.
Flavia, you mentioned that there may still be some hurdles here, that this is something to be watched with kind of a skeptical eye. What does timeline look like then in terms of potentially getting this deal done in terms of developments?
I think right now I think there's a strong sense that this is something that Saudi Arabia really wants and are probably sort of pushing it the most. The timeline we've been given is a couple of weeks, but I think we're sort of sensing a certain degree of hesitation from US officials. And of course, you've got a lot of unknowns, right? Is Israel going to go into Rafah? Will there be a ceasefire deal? All these things are part of the delicate balance and the considerations that these countries are weighing. And another big thing, of course, is that as per our story that we've just published, Saudi Arabia is facing trying to sort of crack down on some dissent in its own country, right? And sort of trying to put a lid on any kind of sort of online protests in terms of sort of criticism of Israel. So they're also sort of trying to control their own sort of, narrative and make sure that, there's a great fear, of course, of protests going back to sort of the Arab Springs, and a lot of countries in the region are sort of concerned that things like that could sort of kick off again.
Flavia, is this a first step to a Saudi-led coalition, a regional coalition that would take control and responsibility for Gaza?
I'm not too sure I would go that far. I think from the Saudi perspective, I think they have really longed to sort of have access to these kind of weapons. And I think they're sort of looking at a timeline of you've got an election year and they sort of want to get this done potentially before the uncertainty around the election. And, you know, this is a way to sort of they're seeing a potential window and also trying to work out how they could potentially overcome a big obstacle in terms of like the Senate, right? Because anything like this would have to go through Senate approval in the US.
Flavia, thanks so much for joining us. Bloomberg's Flavia Krause-Jackson with the latest on those relationships, crucial as they could be to the developments in the Middle East. Coming up, European data is in focus. We'll be discussing the latest PMI readings. We've had the numbers out of Spain, of course, and what they mean for the ECB's rate path. That conversation next. This is Bloomberg.
Good morning, folks. Welcome back. We've had Spanish PMI data out this morning. The manufacturing side of things looking actually a little better than anticipated. Remember, these are primary readings for Spain. We're about to get Italy data as well, dropping onto our screens. 45, so about 5 seconds to go until we see those numbers. But the data more broadly this week has painted a picture of a European economy, a Eurozone economy that's maybe faring a little bit better than anticipated. As I say that, the Italian data drops, and I say drops, it drops. 47.3 is the number on the manufacturing PMI, the prior 50.4. So a mixed picture maybe emerging on the manufacturing story out of the euro area this morning. Spanish data better, Italian data not so good. So let's pull it all together. Zoe Schneeweiss joins us to get an ECB perspective on all of this. We saw GDP data earlier on this week. We can fold in some of this data. We're getting fresh data from Spain and Italy this morning. Zoe, where does it leave the picture?
So manufacturing for a while, for the euro area as a whole, has been quite disappointing. We've had readings below 50, and as a reminder with PMIs, 50 is the line that differentiates between growth and contraction. We've had those readings under 50 for quite a while now in the euro area. That primarily was due to Germany and France, and that in turn is because of the weak situation in China. Germany and German manufacturing rely so much on exports to China. So if China isn't well, that then feeds through. And again, Germany being such a manufacturing heavyweight plays through the whole euro area. The Italian data today obviously are quite a disappointment. Last month they had edged back above 50, so we'd seen Italian manufacturing growth again. But now these numbers are bad, and that's just one of those things as a reminder that Europe is very much split with a very weak manufacturing sector, but services still doing really well.
And it also feels like, and I've been harping on the Spanish story all week long, Zoe, only because it is such an anomaly in terms of the broader data. We had the CaixaBank CEO on saying it feels like the Spanish economy is on another continent altogether. Does that matter when it comes to ECB policy or simply overall growth in the region?
So overall growth in the region, you alluded to it already. On Tuesday, we had that bumper reading of 0.3%, so quite a massive rebound from that very shallow recession we had in the euro area as a whole over the winter. Now, we had that 0.3 reading. In Spain, we had an 0.7 reading. So, yes, Spain is kind of out of this world. Spain obviously had the advantage that while the rest of Europe very much relied, now doesn't rely anymore, on Russian gas, Spain is energy independent. So that fielded the economy there. Now, when we look at the ECB, as we all know, a month from now, they'll be doing that first rate cut. That's June 6th. The question now very much shifts to what happens in July. And if the economy is doing quite well, that does mean that there is the danger that a strong economy will again potentially flame inflation. So the hawkish members on the governing council who say we don't want back-to-back rate cuts, the strong economic readings will mean that they have some ammunition here to hold against the doves, and those doves come from Italy and Spain, although by the July decision we will have a new Spanish central bank governor.
Right, Zoe, really interesting then. If we end up with a cut in June and we really don't know what happens after that, I mean, there's always a danger that if you start a rate path and you only do one, that it ends up looking like a policy mistake. I suppose that's something the ECB will be very aware of.
They'll be very aware of that. At the same time, they can argue that they maybe only want to cut at meetings where they have economic forecasts. So they have 8 meetings a year, and they only get economic forecasts at every second one. So that's the March, the June, the September, and the December meetings. And that then for them can be the way to explain why they don't want to do back-to-back ones. At the same time, the French central banker and others have said, we shouldn't just be tied to these forecasts. So exciting times ahead for the ECB.
Zoe, you follow the SNB very carefully. We've just seen quite strong inflation data out of Switzerland. Does it start to look as if maybe the SNB has made a little bit of a mistake going early?
Well, you say a strong reading. It's a reading of 1.4%. It went from 1% to 1.4%. That the rest of Europe can dream of numbers that low. And Switzerland, again, has quite a generous inflation forecast. It goes between 0% and 2%. They are within target. So what does mean, and overall, if we look at the SNB's inflation path, they actually said their projection for the second quarter is 1.4%. So quite honestly, that means that if the S&P wants to have an excuse not to cut again in June, they would have one. But on the other hand, if I were betting, I still would think that they would cut in June. Particularly, it'll be 2 weeks after the ECB, and it will put pressure on the franc if they don't follow the ECB.
OK, Zoe, thanks very much. Thanks for the analysis. Bloomberg Economics editor Zoe Schneeweiss with the latest on the ECB and the SNB this morning. Here's what else we're watching for then in terms of the data that's still ahead. 1:30 UK time, US initial jobless claims. We also get the trade balance data. 3 p.m. UK time, US factory orders and durable goods. And then later we get a lot of US earnings, and we'll linger on this for a moment. We'll get Booking.com, Coinbase, Live Nation. Kriti's focused on that one. We'll also get numbers out from Apple. This is going to be a real focus, isn't it? The Apple numbers. We're looking for what happens there.
I'm only fixed on Live Nation because Guy Johnson has tuned my mind to it.
Taylor Swift tickets. Coming to Europe. I think she's coming to Europe this month, actually.
So I hear.
I know people who have tickets. I am not one of them.
I was expecting it to be my birthday present. Still waiting on that guy. Let's talk about Apple, though, because this is a really big one.
Is it?
Big one. I was trying to make a streaming connection, but I can't actually remember what is actually on Apple. Nevertheless, let's talk about the hardware piece of the equation.
Not that film.
No.
Aeroplanes.
Sorry, to answer your question.
Correct. Yes. Not that one. I'm going to backtrack here. Apple. The macro story is more interesting to me. I'm curious about how the market takes this, because traditionally when we see these big Apple results, the next day we see it really showing up in NASDAQ 100 pricing, et cetera. It feels like lately that hasn't been the case. Apple hasn't been the macro story that a lot of people watch, despite the fact of that exposure to China, exposure to the earnings story, et cetera. So I don't know. I'm very excited about this one.
Well, but it's a bit like kind of the Fed yesterday. Don't we already know all the news?
Well,
where does the surprise come from?
Well, shall we ask Robert Lee? He might have some new information for us. Robert Lee, Bloomberg Intelligence Senior Analyst. Maybe there'll be a surprise. Maybe we don't know everything about their troubles in China. Robert, what should investors look out for then when it comes to the Apple results?
OK, do you want to start with the bad news or the good news? What sort of mood are you in today?
You choose.
OK, well, I guess the story of weakness in the China business is quite well known at the moment, but I'd say the incremental risk is still to the downside because there's a growing sense of, dare I say, even nationalism in the way that Chinese consumers purchase, a Buy China campaign. Not that that's an official slogan or a policy of the government at this point. But having said that, the domestic Chinese handsets are actually really good. Smartphones are a commodity these days, and if you look at the technical performance and the bang for the buck that you get from a local brand like a Huawei, it's really good value for money, and they're excellent products. So in these sort of more cost-conscious times, people are tending to buy more local in China. So that is a challenge for Apple, not just this quarter, but the coming quarters and even into next year. I don't think we'll see a big change on that. Unfortunately for Apple at the moment, well, their challenge is, where's the big new killer product coming from? We've got the Vision Pro, whatever, but personally, I would argue that is a product for technophiles, people who really like their tech. Is it a mass market product priced at around $3,000 to $3,500 US? It's probably outside the budget of your average consumer, impressive though it might be. So I don't really see that that's going to transform their earnings. The sort of solid part of Apple that should continue to underpin their earnings going forward is obviously services. And if you're captured by the Apple ecosystem, then services remains, relatively robust.
Well, Robert,
Sorry,
when it comes to the downside in particular...
I sense there was a question coming there.
Oh. No, there is. Just thinking for a second. We already kind of got the numbers, though, didn't we? Counterpoint Research put out numbers. We know kind of just how much damage there is going to be. How much sensitivity could you see to the China commentary? I understand that it's a big part of their business, but don't we already have the numbers around it?
Okay, I neglected to tie in some of the comments from my US colleagues who lead coverage on Apple. I think that... Whoops, my earpiece has dropped out.
Oh, we're doing well this morning.
Sorry, just a second. Whoops.
Well saved,
This
Robert.
will go down on the bloopers.
Robert's just about to save the situation. So Robert saves the day. You're OK now, Robert? Go on to tell us about what US
No, I'm
colleagues
OK,
are
I can
saying.
hear you. Yeah, US colleagues have said, I think, it's probably likely you'll see a bit of a mix shift within their iPhone shipments, with a bias towards the higher-end products like the iPhone 15 Max. So we could see the ASPs come out a little bit better than expected, and therefore the revenue numbers for the quarter that are about to report could be at the higher end. But again, the market looks forward. So if we've got ongoing weakness on the China side, that is obviously an ongoing risk for them. So, the key question for investors and for Apple is where is the next big killer product going to come from? And to be honest, it's quite hard to see that at the moment. So I think it will remain challenged for them for some time to come.
Are we just waiting for the AI story to develop and for some clarity on what it looks like for Apple? That's what it feels like investors are just waiting for. Every other stock in the Magnificent Seven has got some sort of narrative around this. Apple doesn't. It is very quiet on what it's doing with AI right now, and we need some information. Are we just going to have to wait until we get that to understand what the strategy is going to be, and then maybe that is the catalyst we can use maybe to move the stock one way or the other?
Yeah, as you know, Apple likes to, it has its bigger product launches and bigger trade events where it likes to talk more about its longer-term strategy and forthcoming product lineup. So having said that, I'm sure they will talk about AI tonight. But again, just taking a step back and being fair to them, maybe more through accident than design, the fact that they are a little bit behind on AI may not necessarily be a bad thing, because at least they're foregoing the tens of billions of capex investments that the rest of or a lot of the other Magnificent Seven are having to invest in at the moment. So in a way, that's maybe a positive for them. And also with partnering with a more developed player, perhaps like an Alphabet or Google, again, maybe a more cost-efficient way for them to gain access to that market. So it may not necessarily be a bad thing in the long run, but we'll have to wait and see.
All right, Robert Lee from Bloomberg Intelligence previewing those Apple earnings for us. We thank you so much. Of course, you do not want to miss our interviews with the CFO of Novo Nordisk coming up just after 9 a.m. London time. And of course, we later hear from the company's chief executive as well. Plus later in the day, Bloomberg speaks to the CEO of Moderna at about 12:30 London time. That does it for Markets Today. The Pulse is up next. Don't go anywhere. This is Bloomberg.